All right, there we are. So we've laid a foundation now with understanding that everything that starts with risk is going to be considered under a 1RR measurement, and that is 1 unit of risk. And that is also equivalent to exactly the maximum you're ever going to lose on any given trade you take. Now, the reason that we work this out very early on is because this is going to set the foundation for how we actually trade for our actual profitability. And one of the biggest problems within this entire space is there is no actual education or understanding behind the fact that this is literally how the mathematics of trading makes you money and how risk to reward actually functions. Whereas people will just risk random amounts of money on random trades, on random funding challenges, on random accounts, on random stocks, on random Robinhood accounts, on random option trades. It's all randomized, right? And they will then get random results, very random results. And over time, the randomness on both the winning and the losing side means that they lose more, because eventually randomness on losing means that you only have so much you can lose, even though the gains can be infinite. But if you have so much you can lose, you're always going to end up losing over enough time. So people end up losing close to everything they ever put their money, close to all the money they ever put into trading if they don't have a system first, and as a result, lose all their capital. Now, instead of being one of these people, you have a foundational approach to trading, which is that we are thinking in RR. And we start with a measurement of just understanding what is 1RR for us, and that is our 1 unit of risk. Okay, we're going to talk about how to calculate this unit of risk in terms of actual account sizes and everything, but this is all you can lose max on any given trade. Now, the beauty of having this defined is that now you'll have a proper measurement for what you can lose. And as a result, you can now focus on your gains, because now what will happen is you'll be able to compare the gains to the losses. And comparatively, when you have a gain that continuously outdoes your losses, that's a profitable system, right? This is when over through the lens of our R, if we have positive values, is it positive or not? And if it is, then that's it. We've done all our job as a trader, right? So the next step is just understanding risk to reward. Now, in TradingView, because this is where the foundation of our entire analysis actually happens, let me go ahead and open a market that I've just been trading. This is a market I've already looked at a few times. So here's a market that I traded, right? And you might see these values next to the market right here. It's saying plus 2.3, plus 11.08, right? This does not mean that I've made $2.3. Doesn't mean that I make 2.3%. Doesn't mean that I make 11.08%. It doesn't mean any of that. All this means is, once again, these are gains in terms of RR. Okay. The way RR functions ultimately, and the simplest way, right, as I said kind of before, is we define our loss, which we understand is -1RR, and then we have an actual risk to reward that we might get out of a trade. So for instance, 1 to 5 is a trade that you might have something play out on, or 1 to 3, or 1 to 15.5, whatever it might be, right? All this means, as we now understand, just taken to its next logical step, is if -1RR is equivalent to, let's say, 1% of our account, which might be, let's say, $1, right? So let's say some of you guys are trading $100 accounts, which, by the way, I don't think you should be doing, but let's just say you are, and you're risking 1% of this, right? Well, 1% of it is $1. So each trade you take, you're going to be risking $1 on the actual trade, on the trade opportunity, and that's exactly what you're going to be looking to lose. Your entire loss for this given trade. So let's say a trade's happening, you get involved in a trade right here, and as you get into that trade, you set a stop loss here. All that means now, when you have a thing down here, is that if price comes here at any point, you'll be out of the trade completely, and you will have lost $1, which is also equivalent to 1RR, which is also equivalent to 1%, because that's what you've now preset as your actual trade. Now, what is risk to reward? What is the simplest way to think about it? Well, it's just how much you make based on the risk. So if you're looking at a 1 to 5 gain, well, that's a 5x gain on your risk. So if my risk is 1RR, then I've made 5RR for that risk, which also simply continues to translate to, if I risked $1 overall on a trade, but I made 5x that, then I've made $5. If I've risked, let's say for 1 to 3, $1,000 on a trade and I win, well, I have made $3,000. If I have risked $10,000 on a trade Now, again, I'm just working up the account size because, again, think back to the way that I taught you guys to think about the fact that the asset and the time frame doesn't matter. What matters is the actual context. Similarly, the account size doesn't necessarily matter. What matters is your understanding of RR, your ability to actually take a trade given the RR calculation that you're using, and after taking the trade to just execute it simply within your RR parameters. So notice how it doesn't matter if I'm trading a $1 risk, a $1,000 risk, or a $10,000 risk. The way it abides by the RR rules is exactly the same. So if I took a $10,000 risk on a trade, and that's one RR for me, so this would be people that are maybe trading a $1 million account, where again, 1% of that is going to be equivalent to 10K, then a 15.5 R return on that would simply be 10K times 15.5, which is 155K. This would be your gain, right? And again, this goes into what we kind of spoke about in the last video, which is that over time, because this is a skill set and it's the only skill set in the world where you can do the exact same action, repeat the exact same action, but actually make more for the repetition of that same action, this is exactly what that looks like, right? As you scale your account and you take a very basic trade that is in line with what you would normally take, and it's a 1 RR risk, all of a sudden, that 1 RR risk with a 15.5 R return ends up being $155,000. And that can happen in one trade. Here's an example. This is a trade that I've kind of broken down a little bit over this portal. I've used it as an example. It's very recent, right? Right now it is 23rd of December, 2024. Actually, at the time of me making this, it's the 28th. And this trade here was taken on the 29th of November. So just about a month ago, this trade right here was taken. And off of this trade, from the initial move to the times that I started to close portions of the position off to the actual delivery, you can see on the TradingView tool right here, there's this thing that says risk to reward ratio. And here it says 22.19. All this means is what it's calculating at any given point. You can see this number kind of changing based on if I make it smaller or larger. All it's calculating is, well, how many of these areas here, based on where I put the stop, how many of these areas here fit into this area here? And at the time of me putting this up here, there's about 21.79 rewards that fit into here, which simply means that if I took a $1,000 risk on this trade right here exactly, which means I entered at this price and I had a risk set down here at $1,000. So I'm going to lose $1,000 if price goes here. Then if price keeps going and plays out to this exact point, and for some reason at some point I close my entire position right here, what that means is I've made 21.79x reward on the risk that I put up. So if I have a 1K risk, well, should be pretty clear. If I have $1,000 risk, then I've made 21.79 if I let this trade go all the way and close here. So the gain on this trade would be plus $21,790. $21,790, which again, when I choose to do some of these examples and show you them kind of in the live example like this, because I want you to truly understand what's available to you. I don't want you to look to another person and be like, oh, are they making money? Is someone else making money? Is this really possible? I want you to look at something like this and then go back and look at your own case studies and your own trades and ask yourself the same question. If I have a dollar risk of $1,000 on a given trade, what does that mean for the potential reward, given we don't consider any other management? We don't close any position. We don't take any partial. So that doesn't, we don't take any closes along the way. We simply just held this trade and we let it go to whatever number. What does that mean? And a lot of you, if you did this little, what do you call it? If you did this little like kind of homework for yourself or this little exercise, what you'll very quickly see is that, hey, with a risk of $1,000 or $10,000 or $100, whatever it might be for you based on your current income or over time where you're going to be able to grow your account too, what you'll very quickly see is the potential upside or the potential reward of the risk that you put behind something, which should also show you what is available to you as you scale your account. So all of a sudden, without having to rely on someone else's own trading, without having to rely on someone who owns signals, or without having to rely on someone else's net worth or capital or whatever they're doing, you can look at something like this and say, I see what's possible for me. I know what I can grow to given the things that I'm doing right now. Let me get to work, right? So Yeah, so that's one thing that you can do. But ultimately, from this trade alone, because we haven't spoken about partials just yet, but very simply, partials are when we close along the way. What I ended up doing is I ended up closing some of my position right here. I ended up closing 50% of my position right here at a risk reward of 4.82, which you can see made me around 2.4, 2.3 R in reward, right? So again, for 1 R risk, the closure of 50% of my position here made me 2.3 R because that's half of what the risk to reward was here, right? I closed 50% of it. And then the rest, I closed a little bit higher. As price began to go, I moved the rest, I believe, to just under this low. And as price took me out and closed my position, I closed the rest at 22.3 R, right? Which was, as you can see here, around 11.08 R gain. Now, again, if I had held the entire position, this entire position here, and I closed the full position up here behind this low, just following this basic higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, right? This is kind of what I ended up following on this move. If I ended up simply following this exact thing and just closed my entire position based on this higher high, higher low, then yes, I would have made 22 risk multiples or reward multiples on my risk, right? Because I had my initial risk set. That risk is 1 RR. And simply, if my risk is 1 RR and 1 RR is $1,000, then 22.3 R gain would be a gain of $22,300. Similarly, if I took this risk and it was a $3,000 risk, this gain of 22.3 R would simply be, right, if $3,000 is 1 RR, then 22.3 R gain is around 63,000 times 22.3 is 66.9 thousand. So $66,900, right? But that's not what happened, right? Instead, I kind of took partials along the way. I took different multiples of risk, like I took little partials off along the way. So up here, I took off 50%. Up here, I took off another 50%. So taking off 50% at this point right here secured me that 4.8, 4.75, whatever it might have been, which added up to around 2.3 R after all this fees, commissions, slippage on the actual entry, stuff like that. And this worked out to being around 2.3 R, and this final partial ended up at 22, which was 11.08 R. So the actual gain that I made on this in RR, right, if you add these up, is 13.38 RR, right, reward. Which means that, again, same thing goes. If I risk $1,000, I made $13,000. If I risk 10K, I made 130K, and so on and so forth. If I risk $100, I just made $1,300 on this trade. So this is the founding principles of just basic risk to reward, right? We have the lens of thinking in 1 RR, 1 unit of risk, and that is actually what we stand to lose on any losing trade. And that's equivalent to a percentage of our account or to an exact dollar value. And then as we trade, what we're doing is we're now able to calculate what our reward based on our risk is. And the reason I lay this out for you is because many places in the world teach you trading in a way that's really, really weird. What I mean by that is, let's say someone is teaching you to do something. Or like giving you signals. What a lot of these groups will do in the world is they'll say something like, okay, guys, I'm buying at $456.84. And they're like, okay, you can be a buyer here. And then they'll say something like, okay, I'll take my first partial, my first profit here, right, at 461.35, and I'll close my next partial here, and then I'll close my last partial here, like once they've actually closed the trade. And the problem is, after the fact, what they'll do is they'll look at this and they'll say, wow, guys, we just made over 43.2 points on this given move, right? I made 43.2 points. Or they'll say something like, guys, we just made this thing move 4,372 decimal places, right? 4,372 bips. We just made this go up, or pips or whatever, right? Or they'll say something like, nice job, guys. We just made 9.57% on our account, or on the move. Yet none of this actually represents what was actually made through the act of buying or selling, because clearly nothing's been defined. But now you have a way to define that, right? Using this exact same tool, this simple trading view tool, and now understanding what you know about RR and risk to reward, if someone had sent out a version of a trade like this, or you're personally doing your own case studies and you're looking at trades that look something like this, where you have a much bigger stop or something, well, now you can work through this and you can say something like, okay, if I had taken some of my position off here, what does that actually mean? Well, what that means is that at this time, you can see right here, it says the risk to reward ratio was 0.18, which simply means that at this time, if you risked $1,000, right, or let's make it this way, if you risked $1, you are currently up 18 cents of profit, right? All this means is that you're up 18 cents of profit. That's all that means, right? So if you risked $100 on this entire trade, taking a partial here or closing your entire position here simply means the trade at the moment is up $1.80, right? So all of a sudden, this misunderstanding about the way that people are taught to think about risk to reward or actual risk goes out the door, and you start to focus on the stuff that actually matters, which is how is risk actually being calculated? What am I getting as a reward for the risk that I'm putting up? And does it make sense to close here, or does it make sense to have a management style that allows me to hold on to trades for longer, hold on to trades for longer, or even better, look for ways to have tighter stops so that when I hold on to trades for longer and get stopped out, that risk to reward on this entire move here would be 5.17, which means if I risk $100, I make 500. You guys should understand how risk to reward works now, right? Because again, this is always going to be 1RR. And we'll teach you guys, I'm going to teach you guys how to calculate 1RR or think about this being in 1RR. Like, how do you actually make this $1,000 risk? How does that actually work? We'll talk about that in a second. That's part of the risk basics. But you then begin to look at the actual model of the market or the setup of the market and decide, does it make sense to have stops this large in reference to the trades that I take? Or does it make sense to tighten up the stops at a potential of getting stopped out, but allowing the move to start so that if I get stopped out here, I'm actually making a 5 risk to reward on my trade? Or if I do end up holding on to up here, I'm now making an 8 risk to reward return on my trade versus the normal way, which is, hey guys, we made a trade that went 9.5%. But again, if you think about this trade, if you held the entire position entirely from the beginning till the end, made you 1.47 times your risk, which means, once again, if you closed portions of this trade along the way. So think about it this way. Again, there's a lot of math here, but if you think about it as I talk about it, it should make a lot of sense to you, right? So just imagine this is a trade that you took. A simple trade. This is the QQQ, this given asset. You took this trade, right? Maybe you saw, let's go through the normal analysis of what you've learned here now. You saw this higher time frame accumulation MB, momentum MB1 on a higher time frame, moved higher, momentum MB2. And then on this time frame, again, you simply didn't even wait for accumulation MBs. You didn't look for any of that. You just simply said, okay, I'm going to buy higher up in this price. I'm going to buy here. I'm going to protect just way down here because I don't want to be wrong. I just want to let this thing maybe make a move. And that's all I'm going to do. And then price begins to move in your favor, right? And then let's say you didn't touch anything. You simply took an overall stop that was initially here and you started moving it up, moving it up, moving it up, moving it up, and you got stopped out for whatever reason, let's say right here. Done. Okay? You got stopped out of your entire position right there. Done. You didn't do anything to the actual position. You simply opened it here and you closed it here. In the event that you did that, your risk to reward ratio of this trade was 1.27, which simply means, right, if 1RR for you is, let's say, 1%, and that's 1% of 100K, which might be like $1,000 account. $1,000 trade. If this risk was $1,000, then simply this risk to reward of 1.27 would mean that you have secured a gain. Let's make it green. That you have secured a gain. How much RR was this? 1.27 of 1270, right? Because again, 1.27 times this number right here, times $1,000. Let's make this larger, right? That's all this means, okay? Your entire gain on this trade right here, if you took the entire trade and you just close it here, was $1,270. Now, imagine this again. So again, let's just say your loss on this is potentially minus 1,000. Okay, let's say that's what you're taking as your stop loss. Let's say by the time you close this trade, for whatever reason, let's say throughout this trade at some point you closed a portion of the position. Let's say you closed 50% of the position somewhere here. Let's not do the math on that. Let's just say you closed 50% of the position somewhere in here, making some money. Let's just call it that, right? Let's just say that happened right here. Well, what does that mean for the the final trade where you took this partial? Well, now your risk to reward is not 1.27, right? Your risk to reward now is 1.27 times whatever is left in the position. So only 50% of the position is left, 0.5, right? The division, which means your actual gain on this final move, okay, was plus 0.635 RR, which means if minus 1 RR, so a loss, is equal to $1,000, then a gain of 0.635 RR times 1,000 is what? Well, it means that your actual gain on this trade at the end of it, once everything is said and done, was $635. Here we are, in profit. That's it. That's all that means for us, right? So, and that's assuming that you close somewhere else, right? So just imagine it this way. Let's say you took this trade right here. You took the trade. Then for some reason, your rule said that you're going to close 50% when you opened it. And then the rest of the 50% you closed here. Well, that's a gain of $635. Now, let's say instead of saying that the position was just closed somewhere, right, being random, let's say 50% of that position was actually closed right here. Well, now we can do the math. We know that this is the final number of what we earned just from this last position. But we also now know that we closed 50% of our, so let's actually label these 50%. We'll make this really large, just like that. And we close 50% here. I'm just doing this so it's very clear and very easy to see. Because again, the way that I like to teach is very, very example-based, example-heavy, and showing you stuff that just literally is in front of you, right? This is exactly how it would look if you had executed this given trade, given these parameters. So let's say you close 50% of the trade at the very end here, right? We already know what that's going to add up to. You made $635 off of this closure. Well, how much did you make off of this one? Well, now you have a very easy way to do this, right? Because all you need to calculate all of these things, right, is to know how much position do you have left, how much, where was your stop, and what's the risk to reward, right? So if I closed 50% initially, right there exactly, and I know my stop was here initially, well, everything's worked out for me, right? 0.52 risk to reward was where I closed 50%. So what does that mean? Well, once again, I closed at 0.52 R, but, right, I closed 50%, which means that I'm only gaining how much RR? Well, 0.52 times 0.5, which is our 50%. That's 0.26 R gain, plus 0.26 RR. Right, same thing here. So again, let me just, I'm going to make this look the same. So 1.2 or whatever that number was. Let's go like this. 1.2 RR, but we took 50% equals plus 0.6. Well, it's 0.6, but 0.635 RR because of how we did the math, right? So again, we're just going through this again. Okay, so 0.26 RR is what we actually made at that point. Okay, cool. 0.26 RR. If minus 1 RR, which is what we risked, was $1,000, because we still know that was the initial risk, because everything stems from 1 RR of risk, which we have defined. Very important, but you now understand that, and you don't have to ever learn it again. 0.26 R gain times $1,000, because that's 1 RR, is equal to what? 260. Plus 260, right? So by splitting up where we took portions of our trade, we actually have two areas that had their own risk to reward because of the fact that we took two partials throughout the move, right? So the actual final trade was worth this initially, right? We had a trade that started, then let's say we closed some of our position here. That's what that closure meant, given a risk of $1,000, 1 RR. And then as price continued, we closed the final 50%, the rest of the trade right here, right? So because of that, we can kind of go through this again, how much was remaining at the time. And we get to this number. So putting this together now, so putting the 635, that's this number here, plus the plus the 260, that's this number here, and adding them together, you get a total gain of $895, right? So you totally made $895. Okay, so for a risk of $1,000, okay, if you took off a 50% partial here and here to close it, you actually gain around $895. On the other hand, if you took no partials, you can run this same mathematics now backwards. Right now, again, I'm just showing you, like, this is like almost like a math class because I want you to understand this so you can have it forever and you just know how to think about this, right? If this is all you have, then look what you have. You have 1.2R, that's your close, 1.2R at 100%. How much is that? Well, that's 1.2 times 1. That's 1.2RR, which means you gained 1.2RR. If minus 1RR was $1,000, then 1.2RR times 1,000 is 1,200. So if you held the entire trade and had, you know, some management to keep moving, and then you got out here, right? You would have actually made more money, as you can see here, than if you had taken 50% off here and 50% off here, right? Because that's what ended up with this value here, that 895. So again, these are, you know, they're somewhat random examples, but the best way to start and the best way to learn how to think is by starting with random examples. But this is fundamentally how risk to reward works, right? You have an actual way to now judge and understand risk to reward. You can now look at the trades that you take and you can understand what the potential reward of that given trade, given the risk, would be, instead of being consistently confused by the fact that there's other numbers associated with this given market. Oh, this thing went up 7.77%, or 3,500 pips or bips, or $35.62. None of that matters, right? What matters is how much risk to reward did you return on the trade that you took. And this is very important because another mini example, right, is if you're looking at something like Bitcoin, this same thing can happen. And again, this doesn't have to come from just signal people or people that are trying to scam you. This can happen from anywhere, even for people just don't understand this themselves, right? You might hear some of your friends, even in your entire life, or people that you're just close to, acquainted with, or investing in some way. They might say something to you like, "Yo, you won't believe it, right? I bought," you know, it might be something like this. It's like, "I bought Bitcoin when it was at $70,000. And then I sold it when it was at $105,000. Can you believe that?" It's like, that doesn't mean anything anymore. It doesn't mean much, right? It's good for them, it's great, but it means nothing in the respect to trading, right? And here's why. This comes right back to the risk to reward discussion we just had, and I'm going to show you this to kind of round this out so you really understand this forever. If I told you I bought Bitcoin at $70,000 and sold at $105,000, it means nothing. It doesn't mean you need to pay for my signals. It doesn't mean you need to listen to me as an investor. It doesn't mean shit. Here's why. If my trade looked like this, because some people did this, they bought Bitcoin and they were ready to potentially lose on it. Let's say if it went to like 30K, they'd be like, okay, I want to get out of it. And they maybe put $10,000 in it, or $1,000 on it, right? They might have put $1,000 of their money into this, right? So they bought Bitcoin at 72,000 and they sold it at 105,000. Now that sounds amazing because guess what? You made $32,499 of potential profit on this move. You made, look at this number here, 45.33% of potential profit. You made 100,422 potential pips or bips on this move. But it doesn't matter because the reality of this trade is, well, you guys know it now. You have the hacking glasses. You can see everything now. You made 0.84 return on your risk. Okay? That's all they did. If they put their entire net worth, okay, right? Maybe one of your friends said, I put $10,000 in Bitcoin. I bought it at 70,000. I took it out at 105,000. Can you believe that? Right? Or if you see a YouTube video online about some stupid shit like this is what's happening, right? A version of this could be happening. And this doesn't mean much because this person just made, right? Do the math. 10K times 0.84. They made 8K. they made $8,000 on this trade. If they risk $1,000, well, they made $840 on this move, right? You now have the blueprint, the hack, to see how someone actually did. Now, what I will tell you, again, I'm going to add this in now because it's important, is I had a trader as part of the Mentafex team that had been part of the team for at least a year and a half, 2 years prior to taking the trade that he took here, that took a trade on a long through this price action here. He sold that long around this price action here. He bought from at 43,000 and he sold at 67,000 or so. Okay, that's a $23,000 move, a 52% move. He made $100,000 on this trade. How did he do that? Well, his actual trade, again, we go through the steps. I don't remember exactly how it looked, but it was a really tight stop. It was a very impressive stop. I believe his trade looked a little bit something like this. Let me take this just so I do the math right. Yeah. This is pretty much what his trade looked like. Now, again, I'm not getting this 100% correct. What I do know is that he made $100,000 profit on this, which was really good. But again, this is for the purpose of teaching you risk to reward and thinking risk to reward. So this trade here is very, very different than the trade here. And even though this trade here technically made more dollars, this trade made infinitely more money because we are now thinking in risk to reward. So what I can tell you is this trader risked $2,000 on his trade, right? He took 2K risk, which is normal. This was around, I think, 1% of his account at the time, right? He was trading around a 200K account. So a 200K account at 1%, which is his 1RR, is equal to $2,000. That's how you arrive at that. So he took a $2,000 risk on this trade. Okay, now that's not taking into account other trades that he might have taken. This is just this trade that he took. And he allowed himself to manage this trade as it went. Through his normal rules, he managed this thing as it went and went and went and went and went, and he got stopped out of this trade somewhere up here, something along these lines. Now, again, I might be getting all the numbers wrong, but the point of this is for risk to reward, right? The gain isn't 24,000. The gain isn't 56% on his account. It's none of that. Instead, it's a measure of the risk to reward. So what do we know? Well, we know that if he's risking $2,000 and he's closing the full position here at 50.16 RR, then we can write that out. 50.16 RR, and 100% of the position is still remaining. So at this final closure, what does that mean? Well, that's 50.16 times 1. That's 100%, which is equal to 50.16. Now we know that minus 1 RR for this client, for this guy, on his 200K account at 1% risk is equal to $2,000. So we know that 50.16 RR gain is equal to 50.16 times the $2,000, right? 50.16 times the $2,000 puts you around $100,320 of profit. Right, so this is your fundamental building blocks of understanding your risk basics, right? You now know at the end of this video here that everything starts with an assumption of 1 RR as a unit of risk, 1 unit of risk. And that's your minus 1. That's how much you are standing to lose max on any trade you take. Simply, if this trade came down here instead, and he never met any other rule, he will have lost $2,000. Done. Lost. Instead, the trade starts making a move. And the move that that trade makes begins to play into the reward of the risk that he put on. If he closed more positions along the way, maybe he closed something here or here or here, that would now influence the overall risk reward numbers, but we would calculate them the same way, right? If someone took, again, here's a quick example. If somebody took a 30% position, 30% of their position off here, so they sold a third, then what's left, right? Well, what actually happens? At 12.82R, right, what happens? 12.82R, how much of the position is being sold? 30%. So how much R is he gaining by selling that? 12.82 times 0.3, right? So what happens at that point is he's making 3.846 RR. Right, this is as simple as the math works. 6 RR at this exact point here. And now what's really important to remember is that only 70% of the position is now remaining for whatever you catch going on, right? And you can keep doing this as you go forward and forward and forward. If you take another partial or another position off here, let's say you take off another 20% of the overall beginning position. So you still have 50% of the position left, but you took off 20%. Okay? Well, if you took off 20% of the position at 33.71 RR, then that is, 33.71 RR, then that is 33.71 times 0.2, and you go through the math again. And that's going to be a gain of whatever number. And then let's say the rest you close right here. Or let's say the rest you somehow close all the way up here, whatever. It doesn't really matter. We can do any numbers. So the rest, you close 50% of the position at 55 RR. Well, if you close the rest at 55 RR, but that's 50%, then that's 55 R times 0.5, which is 20.5 R. So your gain is 27.5 R. And you do the same math, right? If minus 1 R, because you've already defined your risk as 2K, then 27.5 R gain times your 2K is 55K. Yep, 55K. Then you can add all these up after, and that might add up to being worth overall, when you add this one and this one and this one, that might be worth like plus 75K. Now again, you can see in this specific scenario where, we're looking at a move where we're looking at a big close all the way up here or a close all the way through multiple times, you can see that closing multiple times along the way, if a move is to keep playing out and you're to close out a full position, at a really good area, closing along the way will always make you less money than a holding full. That's part of management. This is now where we can get into a little bit about the benefits or the drawbacks of certain management styles. Fixed, loose, let it trail, take partials, take small partials, big partials, whatever it might be. These are just some of the drawbacks, and these are some of the things that you're going to now be able to consider in your own trading. But most importantly, you'll be able to consider them properly now because you have a proper understanding of risk to reward. You understand how to properly measure risk to reward, right? If someone's risking $2,000 on this trade here, that's very different than someone putting $2,000 on this trade here. Right? Everything the same. If someone put $2,000 on this, well, their gain when price goes up here is $3,000 versus $100,000 for the person that put 2K on this. And this further slopes into the benefit and the huge benefit of risk to reward and of trading and how beautiful this skill set can be if you take the time to learn these things. And this is actually also why, actually, we'll talk about this in a future video. But this right here, yeah, I'll talk about it in a future video. I'll leave it for that. This is risk to reward. I hope those of you that didn't have a prior or a good understanding of why we think in risk to reward do now. And I hope also that if you came from many other areas in the world or have shared experiences like the ones I just spoke about, that you now understand what it truly means to think in RR instead of thinking in, oh my God, Bitcoin made a move to $100,000. None of that actually matters, right? It doesn't matter what price something moves to, only how you were able to trade it in relation to RR. And now you know what RR looks like. You have a way to set risk. You don't have a way to calculate everything yet. So that might not be part of anything just yet, which is perfectly fine. But you have a way to set risk and understand what -1 RR is. And because you know how to do that, and you know how to literally look at this tool and read it, this is just the long and short tool available right here, well, you also have a way to understand what the reward of that given risk is. And hopefully, in some way, this also shapes your own psychology regarding trading and risk to reward and what it means to trade full-time and make money trading and all this. I hope it pushes that envelope of your own psychology a little bit more, because now you have an actual understanding of what investing can look like, or trading as an investment or trading for yourself can look like, right? There you are. Let's move on.